Hi everybody, and welcome to our first instructional video. There's a lot of fundamental knowledge in this video, so I hope you will have an opportunity to really absorb what is here. I have also posted this PowerPoint so you have it to look at. And before I go too much further on this PowerPoint, I want you to also see that at the bottom of the PowerPoint there are speaker notes with some of the slides. That makes reviewing this very easy for you when you do it on your own. Okay, let's get started. Here we're talking about a framework for financial accounting, and there is a lot of information here. Okay. Accounting is a process by which we measure financial data. And as you will see, there's two primary functions associated with accounting. What is accounting exactly? Here, people make decisions about companies based on this accounting data. And who are those people? Those people are investors and creditors and customers, suppliers, managers. You see the list there. And they are all interested in what we're publishing. Financial accounting, which this course is associated with providing information for external users. The external users are different from the internal users. When you get to Accounting 102, you will see that those will be associated with our internal users. But here, we're trying to do two things, basically. Measure the business activities of the company, and then through our financial statements, communicate those measurements to these external parties. And there we have our beloved accountants down at the bottom of the page here. And they communicate to our investors and creditors, and these investors and creditors then make decisions about if they're going to loan money to the company, if they're going to invest in the company. And then, again, the accountants then measure activities, and the process continues. Okay, let's take a look at understanding these business activities that we measure in accounting. First, we have business structures, and we have three different kinds of business structures here. A corporation. This is a company that's legally separated from its owners. The advantage is that the stockholders have limited liability. That limited liability is the extent to the money they invest in the company. They can't be sued, in other words. A corporation can be sued. So it's like a person. A person pays taxes, it can get sued. That's what this corporation can do. A sole proprietorship is a single owner, and a partnership is a business owned by two or more people. Neither these sole proprietorships or partnerships have limited liability. They're fully liable for all the actions that they take. But their entity, their sole proprietorship or their partnership, does not pay taxes. Okay, we have three different business activities: financing activities, investing activities, and operating activities. I'll work from the bottom up here. Operating activities are the lion's share of these transactions, and they relate to the primary operations of the company. We spend money on things, we receive money from our customers, those kinds of things are operating activities. Investing activities, this isn't like we invest in the stock market or something like that. We're investing in long-lived assets, as it would be, like buildings and equipment investing activities that we buy for the company. And finally, we have financing activities where we work with our investors and creditors. We'll get into this more when we get into the statement of cash flows, which is a little early to be talking about that at this time. Okay, the basic accounting equation, key piece of information. We have our assets. Those are the resources of the company. Our liabilities are essentially creditors' claims to our resources. And then stockholders' equity is the owner's claims to those resources. So this accounting equation is a fundamental model of how we value the business. So be sure you have that locked down in your memory. Okay, we have revenues and expenses. Revenues are the amounts we recognize when we sell our services or sell our products to our customers. We make money when we do that. Expenses are the costs of providing those services and products during the period. We subtract expenses from revenues to get net income. Some of those expenses, by the way, are taxes. So net income is an after-tax. It's the bottom line difference between revenues and expenses. Other names for net income include maybe net profit or profit after tax or net earnings. Dividends are something we pay in the form of cash payments to our owners, our stockholders in the corporation. Key point here, dividends are not expenses. Please don't include dividends with these other revenues and expenses, and net income is not part of that. All right, so here we're talking about our assets, liabilities, and stockholders' equity. We've talked about that. This sort of sums up the previous slides. And then distributions to our stockholders are our dividends, and then we have our revenues and expenses. All right, take a second and look at this and see how you would answer it. The resources of a company are referred to as. If you chose, answer Charlie, assets, those are the resources of the company that are going to benefit our future operations. These assets are going to include cash, inventory, supplies, building, and equipment. We'll look at that in more depth in this chapter. All right. The amounts recorded when a company sells its products and provides services to customers are referred to as, and in this case it's referred to as our revenues. Revenues are recorded at the time the company provides products or services to customers. All right, learning objective 3. Here, Here, we're determining how financial information, accounting information, is communicated through our financial statements. Our financial statements are a key piece of this course. So here they all are, the 4 of them. They are periodic reports published by the company for the purpose of providing information to our external users. And they include the income statement, the statement of stockholders' equity, and the balance sheet and the statement of cash flows. The income statement is going to report revenues and expenses over an interval of time. Revenues are greater than expenses, then we have net income. If revenues are less than expenses, unfortunately, we would have a net loss. We are going to compare revenues and expenses for the current period, usually a month, to assess the company's ability to earn a profit from running its operations. Here is a lovely, simplistic income statement for the Eagle Golf Academy. They're providing service revenue. So this is a service provider. They're giving golf lessons, all right? And they have service revenue. So when they sell those golf lessons, they make some revenue from their customer. But they have some expenses associated with generating that revenue. We have rent expense, supplies expense, salary, you can see them all there, and total expenses of $6,000. The net income is $1,200 here. So this is the first financial statement that we prepare. The statement of stockholders' equity consists of two pieces. One, our common stock. Remember, this is a corporation, not a sole proprietorship or partnership. And the common stock is what our stockholders have purchased from us and invested in our company. The retained earnings, which we'll get to in far more depth, represents money that the company has made, which we'll explain in far more depth as the course unfolds. So here's what it looks like, a statement of stockholders' equity. And we have a beginning balance. We've issued some stock here, so $25,000. So we started this business this is Eagle's soccer company now, a little bit different than golf. We're teaching soccer lessons now. Here we're going to add those two together, and we have beginning balance plus what we've issued, $25,000. And then our retained earnings represents, we started with zero because this company started December 1, and we added the net income for the period from the income statement that we just showed you, backed out dividends, and that resulted in an ending balance of $1,000. The statement of retained earnings is just that simple. Beginning balance plus net income, or subtract net loss, subtract dividends, give you your ending balance. We add the stock and retained earnings together to get total stockholders' equity. The balance sheet is going to represent the change in the financial position of the company on a particular date. It is constantly being updated. So it's a picture in time. We have our resources, which are our assets, which we previously discussed, and our liabilities and stockholders' equity. And here it is. Here's our key assets. Accounts receivable, money we expect to get from our customers, an inventory of supplies, equipment, and some other assets. Our liabilities, everything payable here is a liability that we owe somebody else. And then, as we just discussed, our common stock and retained earnings. If we do this correctly, you can see that total assets equal total liability and stockholders' equity of $40,000. So I think this represents a good place to start for video number 1, and we'll take off in video number 2 when we continue.